Today, we are cracking open a really fascinating analysis of how gold behaves during these massive market shocks. It's a story about a hidden pattern, one that kind of explains why some investors thrive on crisis, while, others are just left scrambling.
Okay, let's just dive right in. I want you to go back with me to January 2026. Picture two investors, both in Atlanta, both holding gold. They're sitting pretty right before a huge geopolitical crisis just explodes in the Middle East. Now, they start in the exact same spot, but believe me, their stories end in completely different places.
So before this crisis hit, gold had been on an absolutely historic tear. I mean, it smashed 53 all-time highs. It peaked at over $5,500 an ounce. It was the best performance we'd seen in 4 decades. And yeah, anyone holding it felt like an absolute genius.
But then, boom, an oil shock hits. And instead of soaring like everyone, and I mean everyone expected, gold did the unthinkable. It plummeted. In just a matter of weeks, it was down 23% from its peak. And that sudden drop, it triggered widespread confusion and, for a lot of people, just outright fear.
This crash created this critical fork in the road for our two investors in Atlanta. First, we've got Michael Tran. He's an electrical contractor, and seeing his gains just evaporate, he sold, in a panic. But then we have Catherine O'Day, a retired principal, and she held on with, get this, complete confidence.
So here's the big question, right? Why did one investor sell while the other held? I mean, they had the same asset, they saw the same crash, they read the same scary headlines. The difference was that Catherine understood a hidden, repeating pattern, a pattern that Michael just didn't see. That pattern is something analyst Ben, the financial historian, calls the oil shock transmission mechanism. See, Catherine knew that what was happening wasn't just random chaos. Nope, it was a predictable sequence, playing out exactly as it had for the last 50 years. And this mechanism, it explains that initial, really counterintuitive reaction that causes so much panic. So first, an oil shock hits. Because oil is priced in US dollars all over the globe, this causes a massive spike in demand for dollars. So as the dollar surges in value, gold, which is also priced in dollars, it just falls mechanically. It's simple arithmetic, not emotion.
And this is where it gets really interesting. There's this disconnect. While all these leverage paper traders were dumping their positions to meet margin calls, the physical market was telling a completely different story. Central banks, long-term institutional buyers, they were steady. They were actually accumulating gold throughout the drop. So this predictable mechanical sequence, it translates directly into a predictable 4-phase cycle for gold investors. And honestly, understanding these phases is the key to turning that initial panic into a massive strategic advantage.
Think of this cycle as a clear roadmap for what's going to happen. It all starts with phase 1, which is defined by confusion and panic selling. Then it moves into a quiet accumulation phase, followed by a powerful reversal. And it all ends with phase 4, a huge revaluation where the major gains are made.
Our guy, Michael, he's sold right here in phase 1. This is the period of maximum confusion. This is when the negative headlines are just screaming that gold has failed as a safe haven. This phase, it typically lasts about 6 to 12 weeks, and it's practically designed to shake out the uninformed.
Phase 2, though, that's the accumulation phase. This is when the smart money, the central banks, the informed institutions who recognize the historical pattern, they quietly start building their positions. For instance, China's central bank, they just kept buying right through that 2026 correction. They accumulate because they know what comes next.
And what comes next climaxes in phase 4. This is the reevaluation, where gold makes its most substantial move up. And a key signal for this phase is the gold-to-silver ratio. In April 2026, that ratio was over 80, what the analysis calls crisis territory. And that historically signals a violent move up for precious metals is right around the corner.
Okay, so you might be thinking, is this just a neat theory, or is it actually backed by hard data? Well, let's look at the documented historical record, because this pattern is anything but new. For 50 years, this exact pattern has repeated after every single major oil shock. No exceptions. After the 1973 embargo, gold gained 457%. After the 79 Iranian Revolution, 240%. Even after the 2008 crisis, it still rose 159% from its crisis low. Every single time, the initial price drop became the ignition for a major bull market. So here's the takeaway, the crazy part. The very conditions that caused the initial crash, a surging dollar and rising yields, are the same conditions that historically trigger the largest and most sustained advances in gold and silver.
That crash isn't the end of the story, it's just step 3 of a 6-step process.
So what does all this mean for you, the investor? Well, it means you can stop reacting to the chaotic headlines and the crazy day-to-day price swings. Instead, you can monitor a simple 2-part dashboard that's based on this historical mechanism. According to this 50-year model, these are the only 2 signals you really need. Watching these 2 numbers can help you spot that critical transition from the quiet accumulation phase right into that powerful reversal phase.
First up, the DXY, or the US dollar index. After a crisis drives it way up to a peak, history shows that when it falls back below 97, that's a crystal clear signal that phase 3, the reversal, is officially in motion. And the second number to watch is the 10-year Treasury yield. When this yield falls below 3.5%, the opportunity cost of holding gold just collapses. That's the moment when the fundamental arithmetic that was holding gold down completely flips in its favor. Which brings us right back to our 2 investors. Michael reacted to the scary headlines and the falling price. Look, he locked in a small gain, but he walked away from the main event. Catherine, on the other hand, she understood the mechanism. She just ignored the noise and held her position for the cycle's most powerful phase. Ultimately, this whole framework challenges us with a really simple question. In a crisis, are we making our financial decisions based on short-term, emotional noise? Or are we operating from a deeper understanding of a long-term, documented, and predictable mechanism? The answer, well, it could make all the